Welcome, everybody. I'm Mark Peter Davis, managing partner of Interplay. I'm on a mission to help entrepreneurs advance society, and this podcast is part of that effort. Today, we've got Seth Levine on. He is one of the founders and leading partners over at Foundry Group, and he just has played a pretty significant role at the firm level and also Seth individually at helping to shape the venture ecosystem over the past decade. I got to know Seth way back in 2006 when I was first starting the business. I had the fortune of doing a deal alongside him, one of my first deals actually, as a VC. And he was kind enough to mentor me a little bit. He was further in his career at that point than I was. So grateful to have him on. He's since gone on to not only help lead the Foundry Group to big things. They manage over $4 billion. And they have helped to accelerate the democratization of innovation outside of Silicon Valley. But in addition to that, Seth is putting a lot of thought into broader socioeconomic dynamics. He's authored a book and is working on his second. And I just find him to be a fascinating person. So I hope you enjoy this as much as I did. Here we go. Seth, really glad to have you on today, buddy. Thank you for doing this.
Thanks, Mark. It's good to be here.
So if you don't mind, let's start off by just covering Foundry. I think most people know the firm. Foundry is one of the bigger names in the venture market. But, I think a lot of people probably don't have a full sense of the scope of what you guys do and the history of it. Would you just do a quick overview of Foundry Group?
Sure. And just for listeners and viewers, the context here, you and I have known each other since almost the beginning of Foundry. We started the firm in 2006, and you and I shared an investment that we made sometime. I think it was might have been early 2008 or late 2007, but it was right at the beginning of the firm. So you've witnessed the whole thing.
Very gracious enough to spend some extra time with the junior guy, which mattered. So a little bit of incidental mentorship, which was helpful. So.
Even then, I could tell that you were going to do some interesting things, right? So I think that ended up being absolutely true. So Foundry was started by me and three other guys in 2006. We raised our first fund in 2007. Turned out that was a really good time to be investing in early stage companies. We were kind of a classic Series A, seed and Series A investor. And we did that for a while. Our first fund was actually all of our funds were $225 million. We raised a series of those funds over the course of a number of years. And then in 2016, we expanded sort of the scope of Foundry. We started investing in other venture funds. It kind of occurred to us, we'd done a little bit of that on the side just with some personal dollars, but it occurred to us that there weren't really LPs that had been GPs. And we thought it might be an interesting way to both provide additional returns to our investors, but also kind of create a firm that leveraged other venture firms, right? So we invest typically in seed series firms. We now have 47 in the platform, in the portfolio, and then we look not exclusively, but primarily at their portfolios to make our Series A investments. So it's been a wild ride, man. It's certainly. We managed $4.3 billion. So raising to even say that number out loud. It's just crazy.
That's a lot of money. Yeah.
Yeah. It's a lot of money. And but look, you have this at Interplay, right? You start with this sort of seed of an idea and it just starts to grow. And, now you have all these different companies and you're doing all of these different things across this platform that you have. And it's not that dissimilar to what we've done, right? We've added things that have made sense. In a couple cases, we've taken some things away. Along the way, and we've ended up with this, really interesting mix of assets.
So for the seed managers who are going to end up listening to this, are you guys taking new funds into the portfolio on the seed side? Should they be reaching out to you?
The fund portfolio is pretty built out.
Okay. Is there a way you want people to engage if they want to start that relationship?
Well, I'm happy to hear from folks, right? And our emails are kind of all over our websites, but mine is Seth@foundry.vc, so that's easy.
There you go.
So happy to hear from folks. And look, part of why Foundry never really had a vision of firm building. We never thought that we were going to, the original vision was the four of us were going to run it until we decided to not run it. And then we were going to kind of shut it down. That changed a little bit when we brought some folks in to help us with the fund platform. It's not totally clear to me what's going to happen. I mean, I was sharing, Mark, with you before we got onto the recording that this is my last fund. I'm not intending on doing another one. What Foundry itself decides to do, I've kind of decided to kind of stay out of a little bit. But that had been our original idea, was just shut the lights down, and maybe that's what we end up doing. But in that context, part of what we wanted to do by investing in other funds was just to kind of help promote the ecosystem and provide sort of in a weird way this generational transfer, but that wasn't necessarily a generational transfer within Foundry. And I think that that was, for me at least, a large part of what drove me to be excited about the fund's portfolio strategy. I mean, obviously, it's great to have kind of a network of funds that are surfacing interesting companies to invest in, but a lot of it for me was I wanted to work with some up and coming emerging managers and help them be better venture capitalists, and hopefully 20 years after I'm done in venture, they're still making investments and making a positive impact.
This is a really interesting concept that I think my intuition is most managers aren't as forward thinking about as you and I probably have been, right? Whether or not the firm and the brand transitions out with the founders of the firm, or it continues as a going concern after the founders. And not all firms that have wanted to do that have pulled it off very well, right? Returns have dipped. There's fighting. There's all these dramatic dynamics. I have stepped into this with the intent of building a platform that will long outlive me, and not to monetize it after that. It's not about the money. It's about leaving behind an ecosystem that will keep helping entrepreneurs after I'm dead or retired, which might be the same time. So the question, as you've thought about kind of seeding the ecosystem, but not through the brand, I think there's a lot of wisdom in that. Do you have thoughts on what works better, or how people should think about that decision?
I think the thing that you just said that resonates the most with me is that you have a plan, right? That like you have, and I should say it differently, you have an intention. And I think it really is helpful to understand what the intention is. Is the intention that the firm is going to keep going and you're going to find a way to transition that firm from a generational perspective, or is the intention not to do that? And right now, at this moment, Foundry is a little bit in the gray area because we had initially intended on never transitioning. Now it's a little bit open about whether we'll transition or not. So we still have some work to do on that. I think what you just described, your intention at Interplay to say, no, I want this to live beyond me. I think that affects your decision making. Now, you also said something that's really important that I think most firms get wrong, which is that the transfer needs to involve substantive transfer of economics. And I think where we've seen firms really fall down is where the founding partners try to hold on to too much of the economics because they were the founders and they believe they built the brand. And that doesn't leave enough room for the junior folks. And in fact, there are a number of funds in our funds portfolio, where the partners left larger firms where they were not effectively transitioning, right? Because they didn't have enough economics and decided to start their own thing. And I think that I mean, not that money is always the problem. And there's also plenty of other challenges with transitioning a firm. But I think that's something that a lot of firms really struggle with and get wrong. And frankly, very few firms kind of figure out that transition. I mean, venture is such a funny business, right? Because we spend all of our time telling other people how to run their businesses. But for the most part, VCs are kind of crappy at running their own business, right? I mean, both in terms of how they manage
Your
staff.
words, not mine. I might have thought it, but I didn't say it.
I'm happy to say it out loud because I think that it's just like the irony to me of the venture business is that, VCs tend to not be great operators of their own firms. So I think that like taking a step back and really thinking about how you act as a manager in your own firm, perhaps is, an exercise that many VCs would benefit from.
I think the reason, just to take a tangent on this for a second, why this doesn't usually manifest in the right way is a lot of VCs, in my experience, this is just kind of my observation of it, never thought they really went into the business of business building. It was like, hey, we're going to raise some money and do some deals. Yes, we have to have a logo. Whereas I think people who who come at it from, hey, I'm building a business and I need to think about customer service and operations and automation and systems and personal development. You take it with a different lens. And we're very much in the camp of Interplay is a company. It happens to be a service business with two clients, two sides of the market, entrepreneurs and LPs. But we think about it very much in that regard. And then all the things you end up saying to people, you should be doing because they all apply. So it is this weird paradigm that I've noticed. You guys,
and you said something important, Mark, which is that you're building a company, right? And I think that the paradigm that many VCs lack is that they're building a company or a business, right? They're thinking about it more like exactly as you said, doing deals. How do I support the deals?
It's transactional.
Yeah.
It's more of a brokerage type transactional. There's nothing wrong with that. And I think that does dovetail back to like, what are you going to plan to do with the business? If you're doing the transactional thing, retire and shut it down. It's awesome. Train people, help people, mentor people. But it's very different from trying to leave something behind.
Yeah. Well, look, it's intentional.
It's hard.
And I think it's no different than the advice we give to our portfolio companies, right? Which is to understand your North Star. What you don't do is as important as what you do and use that as a framework for making decisions. And I think, the other thing that we haven't touched on is venture is not a particularly scalable business, right? When we started Foundry, I spent most of my time, of course, looking at new deals because I didn't have any companies that I was responsible for. And then you get 3 or 4 years in, and now you've got 3 or 4 portfolio companies that you're managing, and you're spending a little less time looking at new things because you've got your existing portfolio that you need to manage. Well, now fast forward, 15 years that it's been, and all of a sudden it's, wow, I have 11 or 12 companies that I'm managing,
right? You're slammed,
and a few others that I'm not on the board of that I'm also sort of in charge of. And so, you spend a lot less time looking for new deals. And I think that that's something that we often we think about the business as finding the next deal. But the truth is, once you have an established platform, most of your job is how do you help companies in your existing portfolio become more successful and find a way to exit eventually, right? And I think that that's something that we often sort of misallocate time. Because really, and we talk about this a lot inside Foundry. Right now, probably 95% of our time should be spent and is spent working with the existing portfolio, because that's what we're doing. We have an existing platform and we're adding to it, but we're adding to it 5-6 companies a year, maybe, right? Maybe not even that quickly.
Right. Yeah. And we're in a different game. We're a co-investor, right? We do not take board seats. We underwrite our own deals, but we partner with folks that we will play the role you're playing. So it's a completely different strategy. I think there's 2 ways to do this business. Where people get in trouble is when they try to straddle both.
Yeah.
When they want to be the co-investor on the board seats, and then they're not deploying enough capital, because we keep a higher new deal cadence. We do 8 to 12 deals a year.
Yeah.
And we can sustain that because we're not on boards.
Right.
But
and you have a business model that's
like a 2x2 in there somewhere. And people get in trouble when they're not in one bucket or the other, when they're kind of halfway in each.
The other thing I've noticed, Mark, is that people hold on to boards for too long, right? We work with a lot of seed and Series A funds, and I've counseled many of them. Like, you should have a strategy to get off of boards, and actually, we at Foundry have had a strategy to get off boards.
What is that? How should people think about getting off of boards? What's the right timing, the right way?
I think you need to think about what your own sort of zone of expertise looks like. And then also think about what will support your business model. And so for many seed funds, once the company is Series A and certainly Series B funded, it's time to step aside. And in our case, I've felt like, and I've worked with companies all the way to IPO. So it's not that I don't have the board experience through public scale businesses, but we've had a number of, I'm always looking at which boards I'm on, sort of are set up in a good way without, right? And I think that there's this cliche in venture, right? Like, you want to be the first call, which I think is such BS, right? Like, if you're the first call for everything, you have a bad board, right? That's a crappy board. If I'm the first call for everything the CEO can think about, whether that's HR,
right,
sales, M&A, financing, legal, whatever. Like that absolutely shouldn't be the case. We should have a board that has a diverse set of experiences where other people are getting phone calls, right? Not just me as the lead investor or me as a big supporting investor. And so as part of that, I've looked for opportunities to step away from boards. I had this kind of funny experience. One of our companies, it's done extremely well. And I stepped off the board at the series, I don't know, C or D, something like that. I mean, they had a bunch of big investors, Sapphire and GA had come in, and OpenView, and they were really active. In this case, I know the CEO really well. I've known him for 20 years. And I stepped off the board. Well, they raised another round, and one of the new investors called me and basically said, "Hey, what's the problem with the company? Like, why would you step off the board?" I had to describe to them like, "Hey, I'm not looking for check marks on the belt or whatever, right? Like I'm very comfortable with the
thing, though.
trajectory this is on." And I basically said, "Look, I want to get invited. It's on an IPO trajectory, and it's basically IPO scale already." And I said to the CEO, "I want to get invited to the bell ringing." And he and I still have a monthly update call, and I get all the board packets, I read them and stuff like that. But I didn't need to be on the board. He's got plenty of VCs and growth equity now on the board. And I think that's something that people kind of get wrong. Like they want to hold on to companies because it's, I don't know, the ego stroking makes them feel good or whatever it is. And I guess I just don't feel that way. And Foundry doesn't feel that way, right?
Yeah, I think you know what the issue is, and you said it without saying it. It's not about adding value, and it's not even about defending preferred share positions or decisions in a lot of cases. The governance, it's distributed. It's managed by a lot of other people that have aligned incentives. It's the baseball card, right? You get to put on your LinkedIn profile the boards you're on. And I just don't give a shit about that. And I guess you don't either.
We're in the season of it, right? Because Midas list just came out. I didn't look at it, but I've seen on LinkedIn and Twitter and stuff like that, people posting the like, "Hey, I made the Midas list this year" kind of thing. And that's the kind of mentality that contributes to sticking with companies when it's time to kind of move on and focus on other things. And I think in general, VCs can have you have a sphere of influence within a business that's very, very limited, right? You choose to make the investment. There's usually a handful, half a dozen moments in the entire life of a company that were really impactful, a key hire, a key product decision. Those are the things you want to be at the table for and weighing in on, right? The day-to-day stuff can be important. Someone needs to be there for governance. And obviously we do that in a lot of companies, but you don't have to be there for every company. And look, you guys are the embodiment of this, right? You're not taking board seats. And yet I am certain that you have meaningful relationships with many or all of the CEOs in your portfolio, and you're providing value to all of them in a different way, right? Depending on what they need.
Yeah. Yeah. We don't have to sit through the whole meeting to pick up the phone and grab coffee and work through issues. Now, look,
and honestly, Mark, would your life be bad if you never went to another board meeting again? I would be perfectly happy to never go to another board meeting.
No, I'm not a big board meeting fan. I do think that I love the moment where there's a breakthrough, whether that's in a board meeting or any other type of event. That aha moment, that's like crack to me. I love it.
Yeah.
But unfortunately, a lot of board meetings, some months you need it, some you don't, right? Sometimes the issue that's really at hand isn't being discussed, or the management isn't aware of it, or there's politics. And all of those things are really limiting factors. So we very much enjoy being kind of quiet consigliere and just being really there to be helpful and supportive. That's the role we've picked for ourselves. Now there's limitations in our model. We can't run $4.3 billion through that strategy. There's a limitation to it, but it suits us well. But I want to talk about you. Like look, I started in this business in 2006. My first year in, there was a few firms I was paying attention to and learning from. You guys were obviously one of them. You had been in the business before, right? Foundry wasn't your first stop.
Right.
Things have changed. You've been doing this, I'm guessing, for at least 20 years. How has the market evolved? And I know that there's probably a bunch of answers to this, but one of them you wrote a book about. Do you want to talk about kind of how the market's changed and how entrepreneurship in America has changed?
Yeah, I mean, so let's talk about it broadly. And you're right. I've been in venture for 22 years. I started in 2001, which was a interesting time to start. And the venture business, by the way, has changed significantly in that period of time as well. And I think mostly for the positive, right? It was very Silicon Valley centric when I started. We had a lot of trouble raising our first Foundry fund here in Colorado, even though we had a national strategy, but people just didn't understand sort of the idea of running a firm that was national, but based somewhere, I guess, other than the West Coast, right? New York as a market, which is where you started in venture, barely existed, right? I mean, there were so few firms. Think about that now relative.
Back then.
I mean, it's crazy to think about how different it is today. And by the way, that's one of the reasons I spent so much time in New York, because I recognized that I had an affinity for it and I had a good network there, but there weren't a lot of other VCs running around there. I wasn't going to go to the Valley and, somehow make a name for myself. I felt like I wanted to go to a market that I thought was emerging. It's funny to talk about New York that way, but it felt like that in 2006, 2007.
Oh, it was emerging.
Where there weren't as many people running around. Yeah.
Right.
So, but let's take the broader context, because I appreciate you bringing it up. I did, in fact, just over 2 years ago now, as we're recording this, release. I'm going to call it my first book because I'm working on another one, but right now, my first and only book that talked about some of the changes that are happening in the broader entrepreneurial landscape in the United States, and it's called The New Builders, and it describes people that are starting businesses today in America are different than you think. It's certainly different than what's been covered in kind of the traditional business press, and frankly, a little bit different than is funded for the most part by Silicon Valley, right? And it's important to remember Silicon Valley only funds about 1% of companies that are started in the United States. So it's obviously it's a big dollar amount, and these can be important companies and they can be impactful across the rest of the economy, but 99% of businesses aren't taking money from venture. And these are the businesses you see as you walk up and down Main Street or, drive around office parks and things like that. And the truth is the people that are starting those businesses have changed dramatically over the last 40 years. And specifically women and people of color, immigrants, older folks are starting more and more businesses. And we talk about that a lot in the book, right? Women are 4 times more likely to start a business than men. 64% of all female-founded businesses are started by Black women. They're the single fastest growing group of entrepreneurs. Immigrants are twice as likely to start a business as someone who was born in the U.S. But yet we don't really do a good job of allocating capital to them, right? People who have money, or capital allocators, I should say, look more like you and me. And that's a lot of what we talk about in the book, which is there's this gap of capital and also of other sort of technical assistance style resources, mentorship and the same, to these businesses. And the result has been that actually the rate of entrepreneurship in the US has been declining pretty precipitously over the last 40, but in particular last like 15 years or so. Big bump after COVID. So maybe we're bouncing out of it. Nothing like a recession to encourage people to start businesses. We also have sent a lot of money to a lot of people, and I think that that's helped free people up and enable them to start their business. But we sort of sound the alarm in the book about maybe rethinking the ways in which we are channeling capital to these new builder businesses, which I think is really important, right? I mean, we need this dynamism in our economy and this vibrancy in order to stay a strong economy, right? I mean, the small businesses in their first and second year account for more than 100% of the job growth in the United States on a net basis. And that includes venture funded companies too. The truth is for small businesses, they comprise something like 50% of employment in the United States, 40% of US GDP. It's a big economic driver, but we don't talk about it as much because they don't have lobbyists. They don't, they're sort of not in the mainstream popular culture. We really like to talk about kind of the high growth, unicorns, as we call them in Silicon Valley, companies that have the potential to be worth $1 billion or more. But in the new builders, we talk about maybe the economy as a whole needs whatever for unicorns, but we need a bunch of camels, right? Like real actual businesses, right? Not a 10 animal and hardy kind of the workhorses of the economy. And I think that that's something that we sometimes miss when we glorify these kind of scale venture-backed businesses at the cost of smaller Main Street businesses that are really the backbone of not just our economy, but also our communities.
You're talking about a more diverse population building, particularly in the small business side. What's driven the demographic shift? What unlocked it?
Yeah, that's a great question. It's not totally clear. Some of that is lack of opportunity elsewhere, right? I mean, I think when you ask Black women, and we talked to many of them when we were doing research for the book, there are a lot of stories of people feeling like they kind of hit the ceiling in traditional business, and as a result, are kind of forced to go do their own thing in order for their labor to be valued in the way that they think it should be valued, right? And certainly, especially in the case of Black women, we have a 400-year plus history in the U.S., obviously longer globally, of not valuing, like literally zero value, not valuing their work. So there's that side of things. But I think more generally that we've lost this sort of meritocracy in our economy. If you go back 50 years, if you were born in the bottom 25% of wealth in the United States, you had a 25% chance of dying in the top 25%. Easy to remember because it's 25, 25, 25. Today, if you're born in the bottom 25%, you have a 5% chance of getting to the top 25% before you die. So we've lost this idea of economic mobility that was the American dream. I mean, literally, that's what we're describing, right? I mean, that was the American dream, was no matter what your circumstances, you can make something of yourself. And I think that in part, these demographics starting businesses and becoming more entrepreneurial is reflective of that as the path to achieve that, right? Because we have such disparity in access to education now, both public and then college, right? We have vast disparities in access to other resources. And so what you're finding is in those pockets that traditionally have lacked those resources, they're taking it upon themselves to go and kind of figure it out, right? So I think that's what's driving it.
I heard a speaker once upon a time say, if you want to live the American dream, move to Scandinavia. Because the data in the US does not support it anymore the same way it used to. It's not zero social mobility, but it's not as open of a door as it used to be, which is terrifying and sad.
Well, because meritocracy has sort of gone away, right? Because there are so many structural advantages to being born wealthy, right? And being born privileged. And we used to do a better job. Again, particularly like education to me is like the foundation for allowing
and now
people
it's so expensive and
absolutely. And we have very disparate education systems because of the way that most places fund education through property taxes, right? And so that unfortunately has created a system where wealthy areas have better schools because they have higher tax base to support those schools. And I think, and by the way, better private funding in terms of the parents from the school funding it. And that unfortunately has widened the gap and created even more sort of lack of mobility in our economy. So lots of things we could dig in there over the course of hours, right? About what we should do about it. So,
yeah, I'm voting for you for king. What's the next book? What are you going to be writing about? Can you share anything?
Well, it's a little bit about this, actually. It's not a bad transition to it. So I mean, I'm an optimist because of my day job, right? I imagine you share that as well, right?
It's hard not to be if you're VC.
Yeah. Well, you see people with ideas and you need to be optimistic about it, right? You fund possibilities in our day jobs. And so I'm very optimistic about overall sort of our ability to fix some of these challenges in our economy. And one of the reasons I'm optimistic is I'm witnessing, from my perspective, a little bit of a shift in terms of how we think about capitalism, right? And for those of us, for almost anyone listening to this, like we've been stuck in this version of capitalism that was described by Milton Friedman in 1970 in this famous essay he published in the New York Times about the primacy of shareholder value, right? The only job of a corporation is to increase value to shareholders, which he wrote in this article. And that's kind of been the doctrine for capitalism for the last 50 years. It's really certainly all I've ever known, all you have ever known in your business career. And I think we're starting to shift away from that. And when I say shift away, I really mean shift back, right? Because if you think about the U.S. between the years, call it 1945, kind of 46, end of the war, and somewhere in the mid to late 70s. So Friedman's ideas took a little while to get kind of populated into our economy. we refer to that era as the golden age of capitalism, right? There was a much more vibrant middle class. Of course, all these folks came back from World War II, and we built houses, and there was the GI Bill. Talk about access, meritocratic access to education, right? I mean, that was a really good way to give people opportunity. And for a long time in the U.S., we had a view about stakeholders, if you want to call it that, but other people that companies should and can watch out for. Now, I would argue these are all in the long-term best interests of both our economy and the companies. And even Friedman in his article talked about investing in people for the long term is not antithetical to what he was trying to say. But I think we just perverted the Friedman doctrine in such a way that companies were just always striving for that, next quarterly earnings report, right? Neutron Jack, how many people can you fire at GE and make those earnings instead of investing for a longer term? And I think we're starting to see kind of a shift back to that, right? And I think that's, the 2018 Business Roundtable declaration around other stakeholders of a business is a good example of that. And frankly, the fact that almost none of those CEOs felt like they needed to go back to their boards to get approval to sign it, I think is indicative, not that they weren't serious, but that they were already shifting their business practices to reflect this. And so I think we're shifting into a form of capitalism that is a little bit more inclusive, and I think ultimately will allow us to help grow the middle class a little bit more and be more thoughtful about investments for the longer term that are not just in terms of earnings and share growth, right? Share price growth. So that's what we're going to write about, right? I mean, I think we're deep into the interview phase of this book, but we've talked to some super interesting people. Jamie Dimon was gracious enough to do an interview with us. We're talking to Dan Schulman, who's the head of PayPal, in a couple of weeks. We've spoken to a bunch of other business leaders, a bunch of other academics, the head of one of Japan's largest companies. So we're getting a lot of data in, and now we're kind of figuring out exactly how we're gonna write it up. I'm writing it with Elizabeth McBride, who's the same woman that I wrote The New Builders with. So that's been a lot awesome on my mind.
Well, I look forward to reading it. Thank you for doing that work. I want to ask you one thing before we jump off, because I know we're getting to time here. Look, you've kind of had an interesting tour through this VC career, right? To me, you're one of the people who's done a little bit more than just show up and turn the crank and do the job. I think it's exemplified by the book you're writing and the book you've written. You're passionate about this stuff. What's informed your life perspective? What set you on a career of social impact as a sub-narrative or part of the narrative of your venture work?
Yeah, well, I'm going to give two answers. I'll give an answer and then I'll tell a story about something that sort of shaped the way that I think about the world in ways that I don't think even at the time I recognized. But in terms of the direct question you asked, like, why do I take a broad view to these things? I think a lot of it, some of it was just my upbringing and sort of my parents and where they came from. My grandfather on my dad's side, didn't graduate from high school, let alone college. My dad has a PhD, right? I watched this in my own family. My grandfather grew up very poor. His parents were immigrants. They never spoke English. I was extremely close to my grandfather. He was an entrepreneur and kind of made his own way, ended up having a really good middle-class life. And it was a good enough life to allow his son to go to college and then eventually to get a PhD, which I always was part of kind of our backstory. And in my own life, right, we were sort of in the lower middle class when I was born, and I watched, my dad. So my dad was an academic. My mom also has a PhD, so she was an academic. That was a little bit later, but I watched them kind of move out of the middle class and then eventually into the upper middle class, right? I mean, really did well by the time I went to college. It totally kind of changed our life. So I've experienced this sort of in one generation moving from, not going to high school to being an upper middle class citizen in the US. So that definitely informed a lot of my overall thinking. And on top of that, I went to a really interesting, very diverse college in the Midwest. A lot of international students, decent domestic diversity as well, and just people from different experiences. A lot of first-gen college students, and I think that shaped my thinking as well, because a lot of the people I know, it was not a business oriented school. I didn't, most people went into academia. I was the exception to some extent of my classmates to go into business. And I think that helped shape things. But in any event, I was sort of alluding this to this in something that you and I had talked about before. But I had this experience early on in my career, which was deeply humbling, and it really kind of changed my perspective on sort of how to show up in the world. And this was it was 1999, and I was working for a private company, but we were going to go public. And I'd been promoted into this role where it was way above my head. I was the corporate finance half of the CFO role. We didn't have a CFO. It's amazing to me to think about that going public, but we had a chief accounting officer and we had me as VP of corporate finance or something like that. I was leading the effort to go public. And so I was, leading the writing of the S1, all that kind of stuff. And we're nearing the end of the process. It might've been early 2000. At this point. And we went to New York to do a big drafting session for a couple of days. And so I was, obviously the sort of central person from our company in that effort. And I was feeling really good about that. One of our investors was Texas Pacific Group. They were doing a big CEO summit, and they had invited me to come talk about basically like future of technology sort of thing, right? Like, here's this younger guy, I was, in my late 20s. And he's going to come and give this, talk about it. And so there were a group of us from the company in town, and we'd been driving around in this stretch limo. And so I needed to fly to the West Coast because TPG was doing this in San Francisco. And so I left one of the drafting sessions, and I was going to head over to the airport to go to San Francisco. And I'm in I'm in a suit, because we've been with the lawyers and the bankers and all that kind of stuff. And I'm in the back of this limo by myself. And I'm in that kind of back section of the long limo. So I'm sort of facing forward. I have both my hands kind of stretched out. I've got my, I remember it vividly. I'm, crossing my legs. I'm feeling as good about myself as I possibly could. I get dropped off at Newark, and I go in and I look up on the board, and I'm like, where's my flight to San Francisco? And I can't find it. And so this is before, phones that had your tickets and things like that. So I,
Right.
dig out my itinerary, and I realize, shit, I'm flying out of JFK. And for you listeners in New York, it's 6 o'clock or 6:30 at night.
That's 2 hours.
You're not getting from Newark to JFK.
Yeah. You're not making your flight.
Yeah. And so I miss my flight. I end up at the crappiest hotel you can think of in Newark. I get into and so I'm going to fly the next day. I'm going to miss my slot, if you will, but I'm still committed to going to this event. And they were like, well, maybe we'll figure out a way for you to do something small later or whatever it is. And so I'm going to fly the next morning. I go to my hotel room, and I'm sitting on the edge of I've still got my suit on. I didn't even unpack. I'm just sitting on the edge of the bed. And I'm thinking basically what a contrast. Hour and a half ago, I was king of the world, sitting in the back of a stretch limo, about to go hop a first class seat to San Francisco. And now I'm sitting in this, seedy motel in Newark. And I'm going to, sleep for 7 hours or 6 hours. And then I'm going to go get on a flight and be late. And I vividly remember thinking you let it get too far, essentially. Like, humility matters. And I think it was a sign, right? I mean, I believe fervently that this was the universe's sign to me to chill the F out. Right.
Right.
And I appreciated that. Right. I mean, in the moment I was mad, but I actually sort of came around, literally sitting on the bed, came all the way back to this happened for a reason. And the reason is I need to chill out. And I'm not all that. And, one needs to approach life with more humility, right? And that was only reinforced. We went public essentially 2 days before the NASDAQ hit its high in that period of time. And so, by the time the lockups came off and all that stuff, right, the markets had fallen significantly. And so it was a really good prep for me for the next year plus of my life, where I was dealing with the aftermath of sort of the internet bubble falling apart, at this company, and then eventually went over and worked for a Silicon Valley-based venture firm. It was SoftBank Venture Capital, and most of what I did there was also kind of work stuff out. And I realized that like approaching all of that with a lot of humility was the way to be successful at it. And I think that was that moment in time is what really changed my perspective on how to approach work. And I think about it all the time, and it absolutely affects even today how I work with companies.
Terrific wisdom. Thanks for being on, Seth.
Thanks for having me, Mark. This was great.
All right. Well, I am very excited to read his next book. He's thinking deeply about how society is evolving. If you take the type of topic he is covering, it's very timely for me as a person who's been reading Dalio and other types of content out there. There's a Harvard Business School professor, Professor Rawi Abdallah, who's also leading the forefront of thinking in this space. We are going through a new phase of society in American capitalism, and we are going to need a lot of people staring at it, looking at it, and trying to recalibrate how to evolve to adapt for the future.